I have spent most of my life around people who believed a smooth line meant a safe asset. That belief has ruined more fortunes than panic ever did. Panic at least announces itself. Panic rings bells. Panic makes noise. Panic embarrasses leverage. Panic forces truth to the surface in a hurry. The really dangerous phase is the quiet one. It is the phase where the valuations still look civilized, the monthly statements still arrive, the managers still speak in composed language, and the people holding the paper tell themselves that no major problem exists because no major markdown has appeared yet. That is why a headline about a giant manager limiting withdrawals from a credit fund matters more than most people realize. A lot of people read something like that and shrug. They assume it is a side issue. They assume it is a niche problem for rich investors. They assume it belongs to the world of institutions, endowments, family offices, and financial products with complicated names that ordinary people will never touch. I do not see it that way. I see a signal. I see a sign that the market is moving from confidence to doubt, from doubt to caution, and from caution to the oldest fear in finance, which is the fear that the money you believed was available is only available if nobody asks for it at the same time. That is the sentence people need to sit with. A lot of modern finance works beautifully, right up until too many participants try to convert a long promise into immediate cash. When that happens, the real character of the asset gets revealed, and private credit has one character trait above all others. It is illiquid. That fact has been disguised for years by rising appetite, rising valuations, rising paper returns, and a world that was hungry for yield and eager to believe that complexity itself was a source of safety. It was not. It rarely is. If you strip away the language, the broad promise of private credit sounded simple. Banks had become larger, more standardized, more regulated, and less interested in tailoring loans for mid-sized businesses that needed flexible terms. Public bond markets served the very large borrower. Plenty of companies sat in the middle. They needed capital. Traditional channels were either too rigid or too indifferent. So private lenders walked into the gap in the early phase. That was not an irrational development. There really was a hole in the market. There really were businesses that wanted financing on terms that did not fit a standard bank box. There really were circumstances where a willing private lender could underwrite intelligently, charge for the risk, and earn a fine return. That is how many dangerous systems begin. They do not begin as frauds. They begin as useful solutions. Then success invites capital. Capital invites imitation. Imitation invites weaker standards. Weaker standards invite self-deception. Self-deception invites leverage. And leverage always creates the illusion that a good business is even better than it really is, right up until it does the opposite. The part that concerns me is not that private credit exists. The part that concerns me is the scale it reached, the quality drift that came with that scale, the degree to which it got tied into private equity, and the degree to which investors began to mistake delayed price discovery for real stability. Those are not the same thing. A stock that trades every second tells you immediately when the crowd is frightened. A private loan does not. A public market corrects in public. A private market can remain cosmetically calm while the underlying borrower weakens, while refinancing conditions deteriorate, while lenders tighten, while investors request withdrawals, and while everyone in the chain keeps pretending the older appraisal still captures economic reality. That does not remove risk. It stores it. The market likes to call that sophistication. I call it time-shifting reality, and time-shifted reality is still reality. The current debate around private credit often gets framed the wrong way. People ask whether investors simply fail to understand that they bought into an illiquid strategy. That is one possibility. There is always some truth in the claim that buyers should read what they own. But that answer is too convenient, and it lets the system off the hook far too easily. When redemption pressure appears in a fund built on assets that cannot be turned into cash quickly, that event is not just a lesson in investor education, it is also a stress test. It tells you that the desire for liquidity is rising. It tells you that confidence in the future cash generation of the underlying pool is weakening. It tells you that some investors would rather leave early than discover what the true exit value of those loans might be in a more honest market. And that is why a partial gate, a limited withdrawal, or a redemption shortfall deserves attention. It is not the whole crisis. It is the sound a structure makes when the first bolts begin to strain. In this case, the concern becomes larger because private credit did not grow in a vacuum. It grew because three forces reinforced one another. The first force was the retreat of traditional banking from customized business lending. For decades, the number of commercial banks shrank, while the financial sector itself became larger and more concentrated. That sounds abstract, but the consequence is very practical. When a financial system gets bigger and more consolidated, it often becomes less interested in doing small bespoke things. It wants standardization, it wants scale, it wants products that can be repeated over and over with very little variation, that is excellent for mortgages, credit cards, and broad institutional products. It is not always excellent for the owner of a business who needs a lender willing to understand unusual cash flows, collateral structures, or transition periods. So private lenders found a genuine opening. The second force was the explosion of private equity. This matters enormously because private equity and private credit did not merely grow side by side. They fed each other. Private equity thrives on leverage. The entire architecture leans on borrowed money. Investors put up some capital funds, borrow more, portfolio companies borrow in turn. Cash generated or extracted in one layer supports obligations in another. Secondary structures appear, stakes become collateral, debt finances transactions, refinancings, liquidity accommodations, and sometimes the very illusion of continuous momentum. People use different vocabulary for all of this. The economics are simpler than the language. It is debt piled on debt because leverage flatters returns during good times. That created a natural customer base for private credit. Private equity needed financing. Private credit was willing to provide it. Returns looked attractive on paper. New investors saw those paper returns and wanted in new inflows made prior marks feel justified. The machine fed itself. The third force was scale. Unlike a private equity fund, a private credit platform does not always need to identify one operating company at a time and then own it. It can build lending relationships across funds and borrowers. It can operate broadly. It can deploy large amounts of money quickly. It can expand wherever the appetite for financing exists, including into areas that suddenly become fashionable, like data center build-outs and other capital-hungry projects that benefit from optimistic future narratives. That combination was powerful. A real market need, a leveraged customer base, and an industrial way to deploy capital. If you were an allocator searching for returns in a yield-starved world, that sales pitch sounded irresistible. The problem, as always, was what happened after too much money arrived. An investment field can begin with discipline and end with desperation. That shift rarely happens because managers wake up one morning and decide to become foolish. It happens because a pool of capital grows faster than the pool of truly sound opportunities. A lender with a modest amount of capital can be selective. A lender with an enormous amount of capital has a different problem. It must keep the machine fed. That is when standards get tested. That is when yesterday's exceptional deal becomes today's ordinary deal. That is when structures appear that would have looked laughable in a smaller, more disciplined era. And that is when a market that once solved a financing gap becomes a market devoted to sustaining itself. I have seen that movie many times. The names change. The incentive pattern does not. People started to discuss private credit as if it had discovered a superior way to earn equity, like returns with debt, like discipline. That should always make you suspicious. When finance promises a combination that seems unusually favorable, the hidden cost is usually sitting somewhere you cannot easily see. In private credit, a large part of that hidden cost was opacity, because these are private arrangements. Market-wide data is harder to aggregate, valuations are slower to update, and the broader investing public tends to rely on manager commentary, periodic marks, and selective transaction evidence rather than a real-time auction process. That creates a pleasant environment for confidence. It can also create a very dangerous environment for self-deception. One point in the source material struck me as especially revealing. Even the basic middle market private credit loan was being priced at the risk-free rate plus roughly 500 to 550 basis points, which translated to something in the high single digits with the secured overnight financing rate where it was. That is not charity. That is not sleepy old lending. That is the market telling you in its own language that significant risk is present, and that is before you move lower in quality. It is before you account for businesses whose capital structure is already burdened. It is before you account for layered private equity leverage. It is before you account for a world in which refinancing costs rise while revenue expectations soften. It is before you account for the fact that a borrower paying a floating base rate plus a spread may discover that monetary policy itself has become a direct threat to survival. I like simple tests. If the base rate can move enough to transform manageable interest expense into crushing interest expense, then the borrower is not operating from a position of abundance. It is operating from a position where time and refinancing conditions matter a great deal. That is exactly the kind of borrower base that looks fine during easy money years and suddenly fragile during tighter years. The source document makes an important distinction here. Higher rates do not necessarily help private credit simply because private credit charges interest. That is the sort of shallow conclusion people reach when they look only at one side of the equation. Yes, lenders earn more nominal interest, but the asset can still become worse. If safer alternatives yield more, investors demand better compensation for holding something risky and illiquid. If borrowers must absorb higher floating costs, default risk rises. If the credit fund itself borrowed money to enhance its returns, its own funding economics worsen as well. So higher rates can squeeze the system from both ends. That is not a detail. That is the core of the pressure. A lot of financial pain comes from people owning a spread business and then discovering the spread moved against them while the asset underneath also weakened. That is how apparently controlled strategies become unstable. The early years of private credit benefited from a powerful mix of low rates, abundant optimism, and enough genuine borrowers to support the story. But once the market became crowded, the nature of the activity changed. Good loans to good companies on sensible terms are not infinite in supply. Yet capital kept flooding in. When the supply of good opportunities is finite and the demand to deploy money is not, the market solves the imbalance in the only way it can. It goes down the quality ladder, it accepts weaker covenants, it finances structures that depend on continuation rather than resilience. It rationalizes concentration, it extends assumptions from the clean part of the cycle into the dirty part, and because the returns still look attractive on paper, the process continues longer than outsiders expect. There was another passage in the source that I thought captured the rot very well. At some point, private equity began relying more heavily on selling portfolio companies to other private equity firms. That is a telling moment in any cycle. When the most natural buyer for a leveraged asset is another participant running a similar leveraged playbook, you are no longer looking at fresh economic value being discovered in the world. You are often looking at one financial actor handing exposure to another financial actor inside the same ecosystem. It reminds me of property flippers trading among themselves. As long as a new buyer appears, the price can be defended. But the system becomes increasingly dependent on the presence of the next optimist. That is not durable wealth creation, that is circular confidence. Once fundraising slows and investors start wanting liquidity, the illusion weakens quickly. The source describes exactly that kind of rush for liquidity in markets built on illiquid underlying assets. This is where the private credit story becomes more dangerous. If the borrowers are harder to refinance, if private equity exits slow, if investor withdrawals rise, and if defaults begin to edge upward at the same time, then several layers of the machine start asking the same desperate question: who provides the cash? Now, the answer is never comfortable when too many participants ask it together. I also paid attention to the source S discussion of defaults. Fitch reportedly found private credit defaults reaching their highest level since it began tracking the data in the middle of 2024. That history is short, so I would not pretend it gives us a long cycle database. But when a new market is already posting record stress within a limited observation window, that is not the kind of footnote I ignore. It tells me that the direction of travel matters more than anyone's preferred narrative. The broader economy makes this more serious, not less. Private credit is not mostly financing trophy abstractions. It is financing businesses. That means inventories, payrolls, services, locations, expansion plans, and operating continuity. When a housing bubble breaks, that is painful enough. When a business credit structure starts to strain, the effects can spill directly into employment and productive activity. The source points to downward revisions in jobs data and notes the loss of tens of thousands of jobs in a recent month. Whether one focuses on the exact figure or the broader pattern, the message is straightforward. Businesses are already under pressure. Market volatility, rates, tariffs, and weaker operating conditions are all forcing management teams to cut where they can. For indebted firms, labor often becomes the adjustable line item that creates the ugly feedback loop. Weaker conditions lead to layoffs. Layoffs reduce demand. Reduced demand weakens businesses already carrying expensive debt. Weaker businesses default more readily. Defaults tighten lending. Tighter lending hits the next tier of companies. And the cycle feeds on itself. Once you see the loop, you stop taking comfort from the fact that private credit used to be sold as a specialized corner of finance. Corners of finance that lend directly to the real economy are not corners for long when stress arrives. Another part of the story that deserves attention is bank exposure. A great many people comfort themselves by saying that private credit lives outside the banking system, as if that fact alone guarantees containment. The source correctly pushes back against that lazy assumption. Even if banks are not the primary home of these assets, they still have exposure through commitments and financing relationships. The Federal Reserve identified tens of billions of dollars of commitments in late 2024, a dramatic increase over the prior decade, and outside estimates suggested the broader exposure may be much larger. I do not need to know the exact ceiling to understand the point. The point is linkage. Modern finance does not require identical balance sheets to spread trouble. It only requires enough interconnection, enough confidence sensitivity, and enough dependence on rollover assumptions. People often imagine contagion as a dramatic chain reaction that begins after some spectacular public default. In reality, contagion frequently begins in the quieter way. Standards tighten, asset sales slow, marks lag, redemption requests climb. Conversations with lenders become harder, borrowers postpone investments, managers become more selective in granting exits. Investors who never worried about liquidity suddenly start reading the fine print. By the time the crowd notices, the repricing is already underway. That is why I do not dismiss a redemption gate as a mere technicality. It reveals preference. The manager prefers not to liquidate quickly. The investor prefers not to stay. The underlying market is too thin to satisfy both preferences at once. That is valuable information. The source material compares the scale of today's private credit market with the subprime mortgage lending of 2007 and 2008, noting that estimates put private credit in the multiple trillion dollar range, materially larger in nominal size than subprime was at that time. I am always careful with direct historical comparisons. The economy is larger now. The institutions are not identical. The banking system has changed. The exact plumbing differs. Anyone who tells you one episode is simply another episode with different costumes is usually trying to sell clarity that does not exist. But caution about crude comparisons should not become an excuse for complacency. Large, opaque, leveraged pools of credit deserve respect whether or not they rhyme perfectly with an earlier disaster. And there is one feature here that makes me especially uneasy. Subprime helped finance houses. Private credit helps finance businesses. Businesses have payroll, businesses buy inventory, businesses rent space, businesses hire vendors, businesses serve customers. If financing conditions tighten sharply across a wide enough slice of that world, the consequences do not stay trapped in an investor presentation. They walk into towns, they show up in reduced hours, canceled projects, store closures, service cuts, layoffs, and delayed payments. That is what people miss when they assume a problem in private markets will remain private. The impact can become very public very quickly. I am also struck by how this market cultivated a particular psychological comfort. Investors were shown attractive returns, often around the neighborhood of 10% or even more in stronger periods, alongside the soothing implication that diversified lending and professional underwriting could offset the idiosyncratic risk. That sales pitch works especially well after a long stretch where defaults stay contained and where other fixed income alternatives pay very little. But a smooth reported return is not proof of low risk. Sometimes it is proof that risk has not yet been forced through a public clearing process. There is a world of difference between low volatility and unobserved volatility. I would rather know what something is worth in an ugly market than enjoy a beautiful mark that depends on nobody asking too many questions at once. This is one reason I have always favored simplicity in the structure around an asset. If I own a business outright, I can study its earning power. If I own a plain common stock, I can watch the market revalue it every day. If I own a bond issued on straightforward terms, I at least know the contractual structure. But when you move into a world where the loans are bespoke, the marks are infrequent, the borrowers are diverse, the lenders may themselves be leveraged, the equity sponsors are depending on exits, the investors want periodic liquidity, and the bank system has some exposure through side channels, you are no longer analyzing a single business. You are analyzing a confidence mechanism. Confidence mechanisms can be highly profitable. They can also fail in ways that surprise people who confuse smoothness with strength. The other hidden danger in markets like this is moral language. When the good years are running, participants like to talk about innovation, access, flexibility, and democratized opportunity for businesses. When the bad years arrive, the language often changes to systemic importance, market stability, and the need to protect the real economy from disorderly consequences. That translation is important. It means that profits are often described as private skill, while losses are described as public risk. I do not say that to moralize. I say it because it changes incentives. If an industry grows large enough that policymakers fear the knock-on effects of letting it contract honestly, then participants may take comfort from the belief that a rescue is at least possible. The source hints at precisely that concern, with rumors and fears that the Federal Reserve could eventually be pressured to support parts of this system if things worsen enough. Maybe that happens, maybe it does not. But even if a bailout path exists, that does not mean it is painless. The United States is not entering any future rescue from a position of pristine fiscal strength. Debt is already high. Inflation has already done damage to households. Political trust is already strained. And unlike some earlier credit booms, this one did not make ordinary Americans feel wealthy on the way up. It mostly operated in the language of institutions and alternative assets. That makes any public backstop more difficult, not less. I never like putting too much weight on rescue assumptions. The line between can and will is much wider than people think, and the line between announcing support and repairing confidence is wider still. That is why I come back to the same discipline before asking who might save a market. Ask what made the market vulnerable in the first place. Here, the vulnerability is not mysterious. It is a combination of illiquidity, opacity, leverage, quality drift, refinancing dependence, economic softening, and investor expectations that outran the character of the underlying assets. That combination can survive for years while conditions are friendly, then suddenly everybody learns the same lesson at once. The lesson is that a promise of periodic liquidity is only as good as the mechanism backing it. If the mechanism depends on loans that cannot be sold quickly without concession, on borrowers that cannot refinance cheaply, on sponsors that cannot exit easily, and on investors that do not all want out together. Then the promise is inherently conditional whether or not the marketing deck made it feel unconditional. This is where I think individual investors and ordinary observers make the most dangerous mistake. They hear words like private, institutional, accredited, sophisticated, flagship, or alternative, and they assume serious people have therefore removed the normal laws of finance. They have not, they have merely moved them into a different room. If you lend to weaker borrowers at higher rates through structures with less transparency, you are not eliminating risk, you are charging for it. And if you borrow against that process, or if the broader ecosystem around you borrows against it, then you are amplifying it. This can be reasonable in moderation. It becomes hazardous in scale. I do not know whether the current strain in private credit becomes a contained correction, a prolonged ugly unwind, or something larger that forces intervention. Honest people should admit they do not know that with precision, but uncertainty about the final destination is not a reason to ignore the road signs. The road signs are already there. Withdrawals are being restricted in at least some prominent cases. Investors are seeking liquidity, defaults are rising, funding conditions are tighter. Private equity is under pressure. Banks have real exposure. Businesses serving the real economy are carrying the debt, and the market-esque calm appearance is partly a function of the fact that it is not forced to mark every problem to a public tape every second of the day. That is not a small observation. That is the observation. If a public market were feeling the same degree of strain with immediate price discovery, I suspect far more people would be alarmed. Because private credit reports itself differently, it can look orderly for longer. That visual stability may be one of the biggest risks in the entire structure. It encourages patience in the wrong places and surprise at the wrong time. I learned long ago that surprises in finance usually happen because somebody believed a process could continue longer than the cash flows justified. In this case, the private credit machine could keep expanding as long as enough things remained true at once. Borrowers needed to keep paying. Refinancing needed to remain possible. Investors needed to stay confident. Equity sponsors needed routes to liquidity. Lenders needed access to funding. Banks needed to remain comfortable with their indirect exposure. And the economy needed to avoid enough stress that defaults stayed manageable. That is a long list of conditions. Markets built on long lists of conditions are never as stable as they appear. The trouble starts when one condition weakens and everybody says it is manageable. Then the second condition weakens and everyone says diversification will absorb it. Then the third weakens and the language gets more technical. By the time the fourth matters, the crowd suddenly discovers it was never analyzing one risk at all. It was analyzing a stack of correlated dependencies wearing the costume of a single asset class. That is the part I would want people to remember. Private credit was sold as a source of yield, flexibility, and resilience, but some of that resilience was merely the absence of daily public scrutiny. Some of that flexibility was merely a willingness to lend where traditional discipline had stepped back. Some of that yield was simply compensation for risks that become much clearer once money wants to leave. And some of that diversification was only as good as the assumption that trouble in one layer would not arrive simultaneously in others. I never mind a market being tested. I mind a market being misunderstood. What I see in this episode is not proof that every private credit loan is doomed or that every fund is a disaster. That would be lazy thinking. Good lenders exist. Strong borrowers exist. Sensible structures exist. Any large asset class will contain both prudence and foolishness, but I also do not see an isolated quirk. I see a warning that a multi-trillion-dollar system built on non-public marks, aggressive search for yield, dependence on refinancing, and links to leveraged private equity is now facing a world less willing to indulge its assumptions. That matters. It matters because truth arrives differently in private markets. It takes longer to appear. It often arrives through gates, delayed withdrawals, awkward financing conversations. and quietly revised expectations before it ever arrives through a dramatic collapse. People tend to wait for the dramatic collapse because it is easier to recognize. I prefer to pay attention to the awkward phase. The awkward phase is where the future gets negotiated. It is where managers decide whether to defend marks or admit pressure. It is where investors decide whether they still trust the story. It is where lenders decide whether they still want the asset. It is where businesses decide whether they can still carry the debt. And it is where policymakers begin asking whether a private problem may eventually become a public one. That is where we are now. Not at the end of the story, but not at the innocent beginning either. If I were trying to explain the entire situation in one plain sentence, I would say it this way. Private credit looks stable because the market did not have to prove this stability every day. Now the proof is beginning to get demanded. That is why this matters. That is why a redemption limit at a large fund is not just a technical event for specialists. And that is why the smartest question is not whether private credit can survive in some abstract sense. The smartest question is what the real exit value, default risk, and liquidity profile of this system look like when confidence is no longer free. Markets do not fail because risk exists. Markets fail because risk was mispriced, misunderstood, or hidden in a structure that depended on faith staying plentiful. Faith is becoming more expensive. Now, when faith becomes expensive, cash becomes precious. When cash becomes precious, borrowers with weak footing get exposed. When weak borrowers get exposed, lenders get selective. When lenders get selective, investors want to leave sooner, and when investors want to leave sooner than the assets can be turned into cash, the pleasant language drops away and the old reality returns. Money that cannot move when you need it is not the same thing as money. That is the truth underneath all of this. It is an old truth. But markets keep relearning it in new disguises.